Welcome investors to another thrilling edition of Patreon member question and answer, where my Patreon members ask me all sorts of questions about stock trading, individual stocks, general stock analysis, technical analysis, fundamental analysis, etc. And I, based upon my 28 years of investing experience, answer the questions, or at least attempt to answer them. I've been investing since 1996. Not only did I not have gray hair in my beard when I started investing, but I could barely even grow a beard. And if you want to ask a question and have me try to answer it, feel free to join my Patreon. There's a 7-day free trial link in the description below. Please check out my partner, Seeking Alpha Premium and 𝐓-𝐸𝐾𝐍𝐶, also links in the description below. And remember, this is not investment advice, just my personal opinion. Okay, so let's look at the general questions first, and then I will go through some specific stocks that you guys have questions about and or specific trades. If it gets too long, I might break it into 2 sessions. We'll do the general questions in this one, the specific questions on specific stocks in the next one. But let's just wait and see how it goes. All right, let's go to the first question. Okay, first question is from one of my new members, Jose. He actually asked 3 questions, 2 of them about specific stocks, but his second question here is about breakouts. Let me just read it to you. Applying Minervini's trading style, that's 2-time U.S. investment champion Mark Minervini, recently started to trade stock breakouts. I've realized that buying at a pivot point normally ends with a breakout failure and in some cases with a consolidation area breakdown. So let's amend that to say that buying, I'm not sure if you're buying before the breakout or if you're buying breakouts and you're seeing a lot of them fail. But that happens some of the time, not all of the time. In some cases, yeah. Now I'm trying to find entry levels before the breakout. Yeah, and that's exactly that is what is preferred. You want to be in the stock before it breaks out, especially before it gaps up, because then you have that dilemma. Do you chase that gap or not? I'm looking for cheats, what Minervini calls cheats, and stock B calls anticipation setups. Seems to work better. Yeah, breakout buying post 2020, I really think it's gotten trickier and trickier. Maybe it's because so many people now have read William O'Neill's basic breakout buying strategy, how to make money trading stocks. Do you have any tips regarding when to anticipate breakouts and when to wait until the stock bursts? Okay, so yeah, I got a bunch. I could probably make a half-hour video on this alone. But first, let's talk about when to wait until the stock bursts. So I actually recently did a video when to buy breakouts. And there are 4 variables. I'm going to put a link to this in the description, or you can just Google or YouTube search when to buy breakouts, Joe's Investment Express. Basically, you look at the strength of the market. You look at what's going on in the industry. Are the other the other stocks in the industry breaking out and holding up or not? You look at the time of the day. Trust breakouts more later in the day, especially anecdotally, it seems like the breakouts that happen in the last hour or so are often institutional and tend to hold up better than breakouts at the beginning of the day, which are often just retailers running the stock up temporarily. The market cap of the stock, a nice setup. A large cap breaking out of a nice setup seems to work much better than a small cap or micro cap breakout. Those tend to just be retail stocks that retail breakouts often fizzle. And okay, so that's step 1. Step 2, so anticipating breakouts. So yeah, what Minervini does is he teaches the low cheat, the cheat, and the traditional handle. So here's NVIDIA, right? Here's the most recent base here in the spring of 2000. 24. Here's the traditional breakout, but look, we've got this gap here of 5%. Do you chase that gap or not? Now, in hindsight, you do. But ideally, so here's your little cup. Here's your handle. By the way, I really like this shakeout in the bottom. But ideally, you cheat on it. And here is our low cheat. See how, here's your left side of the cup. It breaks through the 50-day. So loses the 50-day, breaks through the 50-day, retests, and now we get this nice little pop, May 3rd and May 4th. Here, May 2nd and May 3rd. Here is your low cheat right there. And then you can add to it right here. Here's another cheat. Then you're already in when this thing breaks out. And you can even cheat on the cheat. And this is an expectation breaker, right? We see this high volume break of the 50-day. And then in just a few days, it pops right back up, finishes near the strength of the day, strongest point of the day. We could even start a position there. Quarter there, quarter there, quarter there, full position there. And then maybe on the second day after the gap up, you add just a little bit more. So you cheat on them. What other ideas do I have for you? Setting alerts right beneath the pivot point so you're ready to take action is something that I do routinely. And then the last thing, if you really want to cheat, now you only want to do this in a bull market and you want to set a time stop in addition to a price stop. But a lot of times you can cheat in the handle. In a bull market, look at this little handle in this cheat area. So see how on this day, May 14th, it finished near the top of the range of this little handle. And see, if you follow that vertical line down, see how low the volume is. See how low the volume is these 2 days in comparison to the days before it. That's all of the sellers getting squeezed out. So we could buy on that day with, say, a 2-week time stop because the volume close to the top of the range, near the top of the handle, and the volume dried up. And then if it doesn't break out and within 2 weeks or so, then you just cut it loose. That'll get you started. Make sure and watch that video on when to buy breakouts. But overall, as Charles Harris, who's one of the best investors of all time, has said, breakout buying, I mean, it still works, right? But so many people know how to do it now. It doesn't work as well as it used to. And I think we want to get creative and cheat. And then the other thing, I almost forgot this one, is buying demand hammer pullbacks. I was just looking at Loco today. I didn't buy it, but I was really thinking about it. Here is kind of this loose, messy base. And where is even this? We don't even really have a nice handle set up here, right? But what we do have is a visual depiction of demand from these demand hammers. See how the price runs down and gets accumulated right there, right here, right here, right here, right here. So you can buy in a bull market, a strong stock, you can buy off of these demand hammers. You can actually buy the demand hammer. So you could have bought this day. What is this? July 10th. Or you can wait for it to confirm the next day when it goes above the hammer. And, you know, there's no free lunch. Either you get a better price, less likelihood of success, or you get a worse price, better likelihood of success. So I do a lot of buying cheats and then buying demand hammers. Okay, next question. Kevin wanted to know if I do one-on-one help, and he wants to learn more about Mark Minervini / Stan Weinstein's 4-stage analysis. I think this was Weinstein's idea, and then Minervini employed it and talks about it in his books and what popularized it. So regarding stage 4 analysis, I'm going to show you an example here, but the best thing you can do, get yourself this old book, Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. When was this written? Let me just check. Yeah, 1988. So it's over, I don't know, 30 some years old, but it's still one of my favorite investing books. It's a little bit more on the advanced beginner. So if you're super expert level, it's probably not going to do that much for you. But if you are a beginner or intermediate, I think it's a great book. And most of it is still really relevant today. He does use the 150-day average instead of the 200-day average. He since, after he wrote this book, says he now uses the 200-day average. But it's really great. And chapter 2 is all about stage 1, stage 2, stage 3, and stage 4. Let me show you a real world example though. Regarding one-on-one help, yeah, I certainly am open to that. In the past, what I've generally done is an interested party emails me a list of questions either on, basic strategy or portfolio management, progressive exposure, risk, whatever, and or they just send me a handful of trades that they want me to go over, or if they just want an opinion on their portfolio, they can just show me their current holdings, and we can talk about how they're looking, their strength technically and fundamentally. So I can do a private YouTube video for you. I also am open to doing a 30-minute live Zoom session. I can show you my charts and stuff. I have not done that before, but would be pretty easy to do. If any of you guys want me to do that, you can just message me privately on Patreon if you're one of my Patreon members, or you can email me joe'sinvestmentexpress@gmail.com, or if you mention that you're interested in the comment section, I can reach out to you. Let's look at the 4 stages. Okay, I got 2 examples for you, Zoom video and Microsoft. Now keep in mind, this is very much an art. And interpretation, but that's good. If we could objectify everything, then the accountants would rule the earth, right? Instead, this is an artist. And so when you develop a keen eye for technical analysis, there's your edge. So the other thing is it's not really rocket science. So here's Zoom video, IPO'd in 2019. Now, sometimes you'll have an initial run up on a recent IPO, and certainly you can try to swing trade this, but in general, it's very difficult. You really want to wait for that initial base, that primary base to set up. So here is our primary base in the later half of 2019. So this is stage 1, okay? Here's our cheat area right about the turn of 2020. And then here, as you can see, it breaks out of this stage 1, kind of a cup with handle. It's a little truncated. That's a little better. Now I made a 6-year chart. So here's your cup with handle. So stage 1 is basically basing action, all right? Stage 2 is when it turns into an uptrend, and you want to catch it ideally right when it goes into that uptrend. You don't want to waste time going sideways in stage 1. And of course, this is easier in hindsight, but here's our stage 2 breakout, and then you want to ride stage 2. Now, you don't have to capture the whole move. The idea is you just capture a piece of stage 2, then you get the heck out of Dodge with your money in your pocket. So you try to capture some of stage 2, and then you look for topping signs, and topping action is stage 3. Sometimes it's wild and abrupt like this. Sometimes it's a really mild rounding top that takes place over many months. In this one, in hindsight, we really have kind of a head and shoulders top, right? Shoulder, head, shoulder, draw a line across the neckline, and when it breaks this 50-day with conviction in the fall of 2020, that is our stage 3 action. And then it is in stage 3 action. Then it is in a stage 4 downtrend, and of course you don't want to be in stage 4 unless you are shorting. Now this was tricky. That it kind of tried to go back into stage 1, got above the 200-day briefly here in mid 2021, then rolled over hard again. Stage 4, and now as you can see, for almost 2 years here, it is kind of trapped in stage 1, trying to set up again. And this could be dead. This might be dead money for years. And they need to do some sort of major pivot they need some sort of catalyst, and so far they don't have it. You don't want to be in the stage one, so obviously you want to be up here. We want to see when it breaks out about above 75. Now you say, what about all of this overhead supply? This supply is 2 years ago. These traders are long gone, or they're going to hold, forever, no matter what. They're going to diamond hand it. So what I'm going to do is I'm going to set a alert. What is that? Yeah, let's say 75. Let's set an alert for 75, and then I'm not even going to bother looking at this thing again till it hits 75. One other example, Microsoft. All right, here is the 5-year chart. So here's the COVID crash, and most stocks made this crazy V bottom. This is when the Fed came out and said they were going to do it, throw everything at the market, including the kitchen sink, to support it. So here's our stage one basing action. Here's our little handle. You buy breaking into stage two. Stage two came into, see, at this point you don't know if it's a stage three or stage if it's a stage three or if it's just a new stage one, another base, right? So we got an uptrend, we got a base. This is all part of stage two. In hindsight, in real time, it's not so easy. Stage two, and then we've got this wild, in hindsight, it looks like we got kind of a triple top here. And then here's our stage three topping action. See how it challenged the 200-day for the first time in over a couple years? That's our signal that the run is over. Stage one, stage two, stage three, stage four downtrend morphing into a stage one cup with handle, rinse and repeat. Now we are in stage two. We better move to the next question. Okay, Niv asks, why sometimes does Mark Minervini enter his trades by the candle itself and sometimes put the stop loss wider? I think you're saying, why does he sometimes put the stop right beneath the low of the day, the candle of the day? It's all about the 5% stop on the chart, or is it's the ideal spot? Thanks. So I did Minervini's private access for almost 3 years, and I watched a lot of his Q and question and answer sessions where he talked about this. So I certainly can't speak for him. And of course, you're giving me generalities. We'd have to look at a specific chart. But so on average, his average stop is about 4%. He often starts with it wider, but then as soon as it starts going up, he starts what he calls improving his worst case scenario and raising the stop up. Secondly, the larger the position, the tighter the stop. So if he had a really large position, that would be a reason to put the stop at the low of the day. Then also, the worse, the more inventive, creative, worse the chart pattern looks, then also the tighter the stop. A lot of investors do the opposite. Oh, this stock is really wild, so I need to give it a really wide stop. But in actuality, if the stock's really wild, one, why are you playing it? Two, if you are playing it, then catch it right where you think it should go up and keep going up, and then cut it off with a really tight stop. I guess one other thing to think about is the size of the bar. Like, let's say we were playing this. Here's a double bottom, here is a handle, and then here is a high handle. Let's say we were playing this high handle breakout. This candle is only 1.75%. So we don't need to put our stop at the low of the day. We could put it down here at about 5% beneath this wall of support. But if this candle was, say, 4 or 5%, then if it reversed and gave back 5%, that would be behaving abnormally. So in that case, we would want to put our stop right at the low of the day. Now remember, you can do a staggered stop. You don't have to only have one stop. You can have multiple. You could put one stop. Let's say you were buying this little pocket breakout. You could put one stop at the low of the day right there. You could put a second stop here. You could even do a third stop down here, way down here at 10% if you really wanted to be in this thing long term. That would only be a third of your position. Hope that helps, and if you really need to ask Mark Minervini that to know for sure. But those are my thoughts. Okay, easy money, e-money. Joe, would you be willing to share what a full position is as a percentage of your portfolio? Do you do different position sizing for your long-term, large caps, or ETF holds? So I can't really answer this for you concretely because my position sizes are really, really dynamic. When I'm doing poorly, I'm taking micro positions. When I'm doing well, I'm putting on big positions, and then there's that area in between. But I guess in general, a full position would be 10% of my portfolio. So if you had a $100,000 portfolio, then a $10,000 position, 10% would be a full position, and then with a max 10% stop, the most you would lose would be $1,000, which would be 1% of your portfolio. That would be in general. But when I'm doing really well and the market's really hot, I'm comfortable putting 25% of my portfolio into a position. So yeah, in general, 10%. So if you had a $10,000 portfolio, that would be $1,000 with a 5% stop. Most you would lose would be $50. Let's see. Do you do different position sizing for your long-term large caps or ETF holds? So yes, it depends on what's hot in the market. It depends on the quality of the setup. But in general, I am more comfortable doing bigger, in fact, much bigger positions in the large caps and ETFs because they move so much more slowly. You aren't going to see most large caps, except for Tesla, of course, going up or down 10% in a day. Same with most ETFs. A large cap like Apple, usually 1 or 2% move is the norm. And then if I'm successful with a long-term large cap or ETF, the position gets big because one, it grows, and because two, I keep adding to it. I trade around a position, trade a little bit into strength, add on to it in new base breakouts, and eventually the position gets quite large. And then unlike many mutual funds that have a requirement that they can't let such and such a position get too big, I don't do that. I don't trim something just because it's, quote, too big unless it's looking like it is overbought. Hope that helps. All right, let's see. Theodorus, Theo maybe for short. 4 questions, but we got 1, 2, 3, 5. I forgive you. Let me see if I can answer some of these. I would like to ask the following. Hope it's not too much. How do you use MarketSmith for your research? Which screens do you use out of all those available? What are the criteria to enter a setup, and in general, your research process? Oh my gosh. Yeah, that's a half-hour video right there. How do I use MarketSmith for research? I look at the fundamentals. Okay. And which screens do I'm going to do this. I'm going to show you for 2 minutes. Okay, now first of all, I've done a bunch of videos on MarketSmith, now called MarketSurge screens. If you go to my YouTube page and type in MarketSmith, MarketSurge, you will see here's a video on the Minervini screens. Here's a video on my favorite, the Code 33 screen. Here's how to find the Minervini trend screens. Here's the 1-month trend screener, etc. So, Theodorus, go back and watch some of these videos when you get a chance. But here is a really quick crash course. I'm going to show you 2 ways I use it. One, I come down here to the industry group tool. Let's see here. Okay, so down in this lower panel, markets, 197 industry groups. Click the toggle switch, click on industry groups, and then I look at the top 15 strongest industries or so. So you click on industry group rank. And now if I'm shorting, I might look at the bottom 15 performing industries. But if I'm trying to go long, I look at the top 15 industries. And for example, number 2 here is steel specialty alloys. There is the industry chart. Go over here on the right side. Here are the stocks within that industry. Click on show component data, and boom, there they are. All right, and then I can use the space bar and I can cycle through, or I actually usually send them over to stockcharts.com because the charts are more attractive. So that's one way that I do it. And then virtually every day I run one or more screens, and you can bookmark them once you have found them. Here's some of my screens. Code 33, that means 3 consecutive quarters of earnings growth, sales growth, and margin growth. Relative strength of 90, earnings plus 75. So you can make your own screen, new screen, make a name, and then you can put in your parameters. I have a video on that, so I'm not going to show you that now. You can also find, MarketSurge is such a treasure trove of information. I've had it for 20 years and I still don't use and maybe don't know about all the different features. But my favorite screen is the Minervini 1 to 4 month screen. So you go here to reports, click on it, stocks, technical. Now look at all these different reports that you can look at. But I go to open technical, and oh, there's a message from my girlfriend. I'll read that later. Technical, Minervini trend, 1 to 4 months. These are stocks that have been in an uptrend for 1 to 4 months. Right now there's 286 of them. And then I go through all 286. There's no shortcut. If you want super performance, you got to do the work. So yeah, the Minervini 1 to 4 month. And then the other one is this code 33. And maybe I think I had to create it, but you just, here, let me show you real quick. New stock screen, 33, save, and then you just go to earnings, you go to sales, you go to margins, and you type in, you pick the parameter that you want. I got a video on how to make this screen, so watch that. Let's keep going. I can't get bogged down on one question, right? Do you use entry points based on MarketSmith, aka MarketSurge pivots? Not sure if there is a proper way to use them. If you have, one second. If you have the MarketSurge subscription add-on feature, I think it's an AI generated pattern recognition. It will draw in, like here, it probably would draw in a double bottom with a handle here. And it'll give you the pivot point. I know I do not use those. I often find that the patterns that they recommend, in their IBD YouTube videos and so forth, that they're often too wide and loose. I can't think of a specific example, but a lot of times I will see the charts that they pull up and talk about where the pivot point is, and I'll look at it and I'll be like, yeah, I see a cup with handle there, but that cup is really pretty short in duration, or the handle is pretty too loose. And then oftentimes there are these large cap stocks with lots of eyeballs on them, and they don't end up working that well. So I don't generally, I use MarketSurge to look at these fundamentals here, and I use those screens, but I use, to find my pivot points, I use stockcharts.com. And then I guess my pivot points are often more creative. Here's CLBT. See how I bought within the handle here, or within the pattern, the O'Neill pivot point wouldn't be till way up here, and I got in just a little bit earlier, cheating on the position. So I guess I'm kind of rambling now. So those are my thoughts on that. Number 3, if a breakout fails, how would you approach re-entering the trade? So one of the things that beginners do is, they buy a stock, they get stopped out, and they say, they get burned and they say, I'm never buying that again. That is a huge mistake. Oftentimes, it's just a matter of the stock has to shake out the shoe clerks, and sometimes you're one of the shoe clerks. So you just wait for it to set up again, and a lot of times you get stopped out, sets up again, and the setup is better than it was when you first entered the trade. You swallow your pride, and you just jump back in. Now, if it was a huge position you worry about, you might want to wait 30 days to prevent the wash sale. Wash sale rule, and you can look that up, wash sale. If it's a smaller trade and you didn't lose a lot of money, then just ignore the wash sale rule and jump right back into it. For example, here's 𝐂𝐽𝑚, and as you can see, I bought kind of the traditional breakout, although the handle was pretty darn short. In hindsight, I should have cheated on this thing. Got washed out with the shoe clerks right here, and then I bought the bounce off of the 50-day. This is actually a better, arguably a better setup. And then, as you can see, took off a quarter for 51% and another piece for 28%. So just wait for a new setup. I guess that's your answer. And a lot of my best buys were stocks that I had to. My best results were stocks that I had to get into 2 or 3 times before I could stay on the horse. Minervini calls this jockeying for position. And it's just, if you're a tight stop trader, that's going to happen. Sometimes you get stopped out 2 or 3 times before you can really get out of the gate, so to speak. I've been looking in the metals mining industries. Do you have a view about them? Yeah, my view is I don't like them. A lot of them, well, maybe not a lot, but they're cyclical. They have boom and bust cycles that last for a long time. And even if they're up and to the right, they are so doggone volatile and gappy and prone to the effect of news events that they are really hard for tight stop traders like myself to hold on to. For example, here's uranium. First of all, notice you had this long 5-year sideways action, and here's another one. What is that? 2 years or so of sideways action. And even in the uptrend, look how wild and volatile that uptrend was. And this uptrend was so hard to stay on. And it's true for most of the metals, whether it's copper, uranium, gold, silver, etc. Here's another well-known one, SCCO, Southern Copper. Look at all these long sideways moves, jagged price action. Now we got some wild topping action. I just can't stay a hold of them. I rarely play them, and when I do, I usually get bucked off. Oil stocks can trend a little bit better, and I do play them from time to time, although even so, they are, like I said, gappier and more volatile, and I do not have the strong success rate compared to, say, tech or retail stocks. Here's one more example. This is XME, Metals and Mining ETF. Yes, it's up and to the right, but look at this wild price action. How do you, so hard to stay in something like that. Then your last question, have you considered or used other methodologies of technical analysis? I had exposure to Elliott Wave, but I lately started switching away from it, and hence I'm here. Okay, so yeah, I've studied a lot about Elliott Wave. Let me preface this by saying that if you find any sort of secondary indicator, whether it's Elliott Wave, whether it's oscillators, whether it's Fibonacci retracements, whether it's tea leaves, if it helps you trade more successfully, then use it. I have not. Elliott Wave is complicated. Basically, in theory, there are 5 waves up moving in the direction of the main trend, and then three corrective waves. And I read John Murphy's books and looked at countless examples of when it did work, but it seems like while I could find instances where it did work, many times the stocks were much more random, and trying to identify the waves was pretty was not very productive. Stan Weinstein's 4 stages of what a stock does, also talked about by Minervini, are so much better, in my opinion, than the Elliott wave thing. I do believe the 2 Elliott wave-esque things that I do use as the measured move pattern, which I really think it is very real. Over and over again, you will get a, let's see, where's my, yeah. Over and over again, you'll get an uptrend and then a rest phase and then a second uptrend. That's called a measured move. And then it'll pause out and base out again. So I use the measured move all the time. And then also the 3 tests down or 3 waves down. A lot of times when a stock or a market is in a correction, you will see 3 waves down. Here's the cues in what is this, summer, fall of 2024. Let me get out my snipping tool here. A lot of times when something has a correction, you'll see 3 waves down. 1, 2, 3. Low, lower, lowest. So I look for those 2 things. Personally, I just completely ignore Elliott waves now. And also, for that matter, I ignore Fibonacci's. I know people, there are Fibonacci patterns in nature, and many people claim that you can use them in investing. There's even, like here is the Fibonacci retracement tool on stockcharts.com. And, you know, sometimes they line up and sometimes they don't. Here's that same correction in the Qs. And, you know, did it retrace to those Fibonacci? Well, I don't even know how to use this thing. Hold on. Okay, so you got to go from the bottom up. So here's where it bottomed. Boy, that is very hard to see. You know what? Let's just move on. My point is I don't use Fibonacci retracements either. Sometimes they retrace to Fibonacci percentage number, but that seems more like coincidence than the Fibonacci numbers really affecting things. Let me know your comments on that. Maybe you have had success with the Elliott wave or Fibonacci retracements. Basically, I screen out all the noise. I use very few, I don't use most of the oscillators either. I mainly just use price and volume relative strength. All right, Nico, one of my more active Patreon members, really appreciate his input. Once input. He wants me to go over 4 stocks. Yeah, those are some interesting names. Let's do that in the next video. I'm just going to do general things in this video. I'll do this one. I'll get to these ones tomorrow or soon. Here's Leanne. Hey there, Joe. Hope you and Teresa are all nestled in. We are enjoying our new house, but gosh, we still have boxes all over the place. We downsized by almost half, and so we've got way too much stuff. So we got to figure out where to put it, and some of it we might have to, I don't know, garage sale. Our Facebook Marketplace. After you've completed your scans and all your alerts are set in place, what is your daily routine between the morning and afternoon bells? All right, I just took a minute and wrote out my daily routine. I used to do all of this in addition to a day job, and it was a ton of work doing these things simultaneously. And now I have the luxury of doing it, focusing on the market full time, which is awesome. So in the pre-market, first of all, I look at my game plan. Every evening I have an index card and I just write game plan, and then I write down stocks I'm planning to buy the next day if they are behaving constructively, and or add to if I have them, or positions I'm worried about that I might need to sell, etc., etc. So in the pre-market, when I get up, market here in Montana opens at 7:30, so I want to be looking at the charts at least by 7. But 6:30 is better. So I look at my game plan, remind myself what I'm going to do. I get those charts open and ready to rock, so to speak. Then I look at the pre-market action, what's going up, what's going down, and I read news items on Seeking Alpha. I have this is my partner, 𝗕𝐸𝐼𝐵. I've got several portfolios and watch lists on here. Oh, new custom view fields. I'll have to look at that later. So here I can look at the pre and post market action, and I can come down here and read news items and analysis items. So I go through that, and it doesn't take long, 15 minutes or so. By the way, if you're interested in 𝗕𝐸𝐼𝐵 Premium, there's a link in the description below. Okay, so then at the open, first of all, you can't panic. A lot of the action at the open is just retail cowboys moving things up and down, and those breakdowns and breakouts often fade. So you gotta figure out what's really breaking out and what's really a concern and what is a head fake, and that's where the years of experience kicks in. At the open, I open my portfolio on E-Trade, and immediately I start with which stocks are down the most, because I want to defend. I want to cut my losses, sell my losers mercilessly. So I look at what stocks are down the most and see if I'm anticipating a bounce, or if that's normal corrective action, or if something has changed and I need to get rid of the stock. And then I rescreen it, or I flip it. What do? I click on the heading and flip it so that I can see the stocks that are up the most in my portfolio. And then, the amateurs, including me back in the day, I would say, oh man, look at this stock is rocketing, I gotta buy some more of this. But now I think the opposite. Oh man, this stock is up 7% today, maybe it's time to trim some. So I look at the stocks that are up a lot and trim them, or tighten up my stops. And then I always get a wave of alerts, because I use alerts so much. I put them at breakout points, at breakdown points, and right now I have 499 alerts. See all of these alerts? These are all running. So on any given day, I'll have 5 or 10, sometimes 15 of these alerts go off. I'll go through all the alerts and see what's going on, and many of the alerts, either that's a stock I already have, stock on focus list, which means it's time to buy that stock, or it was a stock that I had not been watching closely, and now it's time to put it on focus list, or at least watch it more carefully. So I go through, here's my alerts from today. So I go through all these alerts. Now, all of these weren't at the open, but many of the alerts are at the open. And then I can take a little break, get another cup of coffee, stretch, maybe do a quick workout or something. And then, it varies day to day. And on my game plan, I make a little to-do list for what I want to do the next day. Some days I'll look at a particular hot or cold industry. Right now, like today, I went through all the semiconductor stocks, trying to figure out if this is just a little natural correction and they are about to run again, or if they are going to break down for a few more weeks or months. So I look at a hot or cold industry. Then I try to run at least one screen, either those MarketSurge screens I showed you, or on stockcharts.com. There's another good screener here. Right here. Where is it? Your scans. I guess it's called a scan instead of a screen. And there are all these different parameters. It's really awesome too. By the way, if you ever want to subscribe to stockcharts.com, put my email in the referral box. I will get a free month's subscription, and I will be eternally grateful. By the way, if you haven't liked the video, please like the video. If you are not a subscriber, please consider subscribing. So I'll run a screen on MarketSmith or MarketSurge or stockcharts.com. I like to run the Minervini 1 to 4 month screen multiple times a week. That's probably the best screen. And then also, call me a glutton for chart watching, but at least once a week, I will look at an entire index, the S&P 500, or the small cap 600, or et cetera, et cetera. So let's say today I want to look at all the stocks in the NASDAQ 100. Click add, click run scan, and there they are. And then you can put save to a chart list, and it will put them in a chart list. For example, here's the S&P 500, all 500 charts. So I will roll through these once a week. And once you get really good at this, you can get through the whole list. Like that looks pretty good. 𝐓-V, here's your cup forming. You can roll through these. I can get through 500 charts just like this. That's got a little potential in, maybe 15 minutes or so. It doesn't take that long once you get good at it. You just keep rolling through till something catches your eye. That's got a little bit of potential there. I'm not going to belabor this point too much, but I'm looking for setups to the downside or the upside, and also looking at the health of the market in general. It looks like we see a lot of basing patterns. So I would say the S&P 500, here's a cup, is most of the stocks are in bases right now. That's good information. What you have to do is not compulsively check your portfolio, especially your balance, every 5 minutes or every 15 minutes. I try not to, once I get through that morning action, I try not to look at it. I just look at it every couple hours and then take a really good look at it the last half hour before the close and then after the close. You don't want to get obsessed, and those alerts protect you. Set alerts at price points to the downside and the upside, and then you'll know via an alert when one of your stocks that you own or that you are thinking about owning is breaking down or breaking out and you need to take action. Otherwise, you will go insane looking at your positions and waste so much time. Lastly, after the close, go over my positions one more time, tinker with the focus list, add stocks, drop stocks, and then, fill out the game plan. And I need to do this for tomorrow. I will do this after this video. Last question for today, and then I promise I will do the specific stock questions in the second Q&A video, hopefully tomorrow if I can get to it. Rick, this is a hard question, Rick. Hi, Joe. Any suggestions on development of a weekend routine to grade stocks and narrow the focus to a handful of names? Going to search your videos to see if you've already touched on this. So what can I add that I haven't already said? I use those screens, and I move stocks off of the screens onto focus lists. I also go through my current focus list. How do I know? I don't grade them. I don't physically write down A, B, C, D. I like actually Minervini's, because I'm a poker player, I like Minervini's method of thinking about patterns in terms of poker starting hands, aces, kings, queens, jacks, etc. Ace, king. Basically, I've got my focus list, I've got my screens, and I go through it, and then I know when a stock is ready when I see it. Like here's kind of my hybrid focus list / watch list, which I use to generate my focus list each week in addition to those screens. It's like, 500 stocks long or so, and I go through this and I just move them to a separate focus list when they're ready. And there's just not really a shortcut. You just gotta go through charts. If you want super performance, you gotta put in a super amount of work. There's no other way that I know of. So I would just go through here and look and see. That's Apple's definitely a watch list now. It's way too extended. I just go through and wait for something to catch my eye. A lot of these are extended. A lot of these are in bases. That's a decent base, but it's too short. Okay, here's one, AIT. So here we've got prior uptrend. It's a little bit choppy. That would ding it a little bit. But here you've got a pretty decent double bottom breakout. It has come in quietly, and it looks like it's about to do the old pullback by bounce. So if I were, so I'll move this to my focus list, and then if I were putting out my weekend video today, this would be on my focus list. And I probably set an alert above this. We can use this one candle as a pivot point. Turn on my inspect tool. High of 208.24. What's the volume been doing? So let's set an alert at 208.2, just a little bit beneath that pivot point. That's all I can say, Rick. I'm not sure. As far as a weekend routine, run your screens, go through your lists, move them. So you got your portfolio, and then you've got your focus list, which is stocks that are buyable within 5 trading days if they are constructive. Then you have a watch list, stocks that are in uptrends, but maybe they are too overextended, or just finishing up a base, or something that's preventing them from being on focus list. All right, you guys, I need to move on. Hope you found this video helpful. It's kind of taxing on my brain. And like I said, I will do the Patreon specific questions tomorrow or soon. And if you want me to answer one of your questions, please consider subscribing to my Patreon 7-day free trial, link in the description below. Take care, everybody.